call the meeting to order at 10:05 p.m. or I'm sorry, 10:05 a.m. The members present, I suppose we could have each of us name ourselves off as we go through. Mike Archikowski, chairperson. Next.
Ken Lamar, secretary.
Mary Schlett, treasurer. We'll excuse Gigi unless she shows up later.
Do we need a motion for that?
Could hold off. We do, but can adjust it later.
All right. Let's excuse Gigi for now. Do we have any agenda changes? Hearing none. I'd like to talk about approving the agenda from last time.
So moved. Is Mary.
Second, Ken.
Okay. I have no announcements. Do we have any public comment?
None.
Nope.
Move on to presentations. I believe we're joined by Wells Fargo Investment, Jeff Blewett and Kurt Augustine. You gentlemen ready to present?
Yep.
Yeah. Kurt, did you want to go first?
I think so. If I could just go first. I sent out a presentation, but I'm not going to go through it page by page. It's a lot of the same information of the, just letting you know about the migration from Wells Fargo, the administration from Wells Fargo to Principal. That is in planning. We process about 68 monthly periodic payments for the pension plan. Most are ACH, a couple are checks, and it's about $202,000 a month, so out of the pension plan. That migration, what we did was we had to choose a successor trust system, and very happy to say that it's the same trust system that is currently being processed on the system for Wells Fargo. So there will be no real changes when this migration happens. It's going to happen over a weekend, and this has actually been pushed back. It was going to be early next year, and now it's going to be migration is going to be a weekend, probably Labor Day weekend in 2021. So up until that time, really the service model is the same. All the people are the same. We'll continue to deal with you and the pensioners as we have in the past. And then over that weekend, just going to change. The only real changes will be logging into a different website and have a little bit different look and feel. But other than that, we're very excited about it. Very happy that this is, everybody's taking their time with this migration and making sure that everything is in place to have really a seamless switch over. So.
Okay. Kurt, can I stop you there for a sec? We have a new joiner. Gigi, are you on the line?
Yes, I am. Can you hear me?
Pleasure to see you. Yeah, we can hear you. Thank you.
Good. Hi. Sorry, this is what you get when you put an old person on your board. Technologically challenged.
We're in the same.
I'm right there with you.
Let the record show that Gigi's joining us from home on Zoom.
Good.
Any questions for Kurt?
I don't have any offhand, no.
Okay. Thank you.
Kurt, I wanted to ask you.
Yeah.
What did you say about the $2,000 per month? We're cutting 68 checks a month, and there's 2,000.
I'm sorry, $200,000.
You cut out briefly on that. $102,000 above.
$202,000 a month. Yeah.
All right. Thank you. Any other questions for Kurt? Hearing none. Anybody, are we okay to move on to Jeff?
Yep.
Jeff, if you're there, go ahead.
All right, thank you, Mike. Thank you, Kurt. So we were unable to meet at our last meeting, so my comments are generally between, let's call it January 1 through now. So it's going to be a little broader than just the last quarter. So the good news is there's lots to talk about. The bad news is there's lots to talk about. I mean, obviously it's been an unprecedented year this year in the market. So I want to go through sort of what happened, where we are, and how it's impacted us and where we're at. So I've been using this analogy. So say the market was a person. February 24th, he put a tinfoil hat on and climbed into his basement. And he started hitting the sell button. He panicked, or she panicked, whoever this market person is. Then on March 23rd, whoever this person is slapped themselves and they turned into the dude from Big Lebowski, and they just stopped caring about the news. And all of a sudden, just started buying really everything under the sun. So we had an extreme month of selling. And since March 23rd, we've seen buying. And yesterday, you saw all-time highs on the S&P 500 and the NASDAQ. I mean, who would have called that on March 23rd? So this market has certainly come back. It's certainly unclear where it goes from here, but it's just been a crazy year. So I'm going to go through some of the numbers. So if you flip to the asset class returns, does everyone have the portfolio in front of them? Everyone able to access that?
I
Yep.
do.
Yeah, we're good.
Okay, good. So on the far right column, the year to date, it really tells the whole story. So government treasuries are up 21% year to date. You see the bonds leading the way. And then towards the bottom, you see some of the riskier asset classes, which stands to reason, right? So you've had a flight to quality. People have been sort of running for the hills, buying bonds and selling a lot of the other asset classes, even though they've been buying them back since March 23rd. But it really tells the whole stories, and it really parallels 2008 when you look at the stack rankings of the asset classes with government treasuries leading the way with a huge return of 21%. So bonds have certainly had a good year. So on the next page, looking at the equities, again, in this quarter, we've seen incredible strength. So S&P 500 quarter to date is up 20.5%. That's amazing. I mean, it's rare, very rare to see double-digit numbers, let alone 20.5%. So year-to-date, S&P was down 3.1% as of June 30th, and it's since turned positive. Again, we're all-time highs, S&P and NASDAQ. It is telling that the growth versus value. So you look at the Russell 1000 growth versus value. Growth is blowing the doors off the place, up 27%. Value's up 14%. And this discrepancy between growth and value has been going on for about 10 years now. At some point, we do expect that to reverse and value to take some leadership. That might be the next stage here, something we're watching very carefully. But certainly in the last few years, growth, think Facebook, Amazon, Netflix, Google, just done really well. And if you look at the other asset classes, it's really the same story in terms of sort of climbing out from the bottom. International is behind where the US is. I think the biggest reason for that is, we just had a more stable boat to begin with in the European markets, Asian markets still playing catch up. Even though they seem to be doing a little bit better with coronavirus, the US market just doesn't seem to care about that at the moment. But international is lagging. So some of the sectors that have done the best, discretionary, tech, energy's done the worst year to date. Financials has been very poor. So it's a broad discrepancy among sectors. So stock pickers are, if they're picking the right stocks, of course, they're doing really well. Big divergence between growth companies and energy and value companies. And like I said, international is still playing catch up. But I mean, all the quarter to date numbers in the first column, very, very strong. So certainly welcome news from the 331 report where the S&P was down 20% if we were to add that last meeting. So on the next page, looking at bonds, in the year-to-date column, just a really good year for bonds. They're up 6% if you look at the aggregate. And that makes sense. I mean, that's just where the money's gone. The most recent quarter, U.S. high yield, also known as junk bonds, which are the risky asset class in fixed income, up 10%. It's just an incredible quarter. So basically, investors just coming in and snapping up anything they could. The riskier, the better in the recent quarter, and it certainly helped. Next page. So the labor market obviously has been a big trend in 2020, and we've had extreme numbers in terms of unemployment. The government programs have certainly helped, and that's where a lot of the rally came from on 323, and sort of the momentum started there. But labor markets are doing better. There are certainly some question marks in terms of what this means going forward, what the reopening means. I can't answer a lot of those questions, nor can anyone else, but labor market and economic data has basically been V-shaped. The market is the leading indicator. So the market's out front, and now you're seeing labor markets, unemployment doing better, starting to sort of level off. But again, hard to say where we go from here. So on the next page, looking at the international, as I mentioned, same boat as us. International is just kind of clawing its way back. They are weaker economies at this moment, but they were also weaker economies going into the pandemic. So it stands to reason that they've been struggling. And again, their coronavirus response is arguably been better. I mean, their numbers are certainly better. There's no question. So it's worth watching. Next page, economic market forecasts. So I want to get into sort of where we are, where we think we'll be at the end of this year, and where we think we'll be at the end of next year. Our best guess is at the end of this year, US GDP growth will be down 4.5% from the year, which is powerful considering we had a negative 5% first quarter and a negative 30% second quarter, which was just, again, unprecedented. Hate to overuse that word, but it really was. So we think we're going to be negative 4.5% this year, which means that we're going to see strong growth numbers in the third quarter and probably in the fourth quarter. That's what Wells Fargo is suggesting with that number. Then at the end of next year, we'll be up 3%. So we're going to see growth in the third quarter, fourth quarter, and then moderate, sort of tepid growth in the next year is our best guess. On the developed global side, down 5.7% at the end of the year is our expectation. So softer than the US, and only 1.3% growth next year. So again, softer than the US. So the takeaway from these numbers is we think we're going to see growth in the third quarter, fourth quarter, and into next year. So we're reasonably optimistic in spite of everything. And at the bottom, sort of the same thing with the equity markets. S&P 500 latest here is 3,100, but as of this morning, we're at 3,430. So we're already above the 2020 year-end target. So I wouldn't be surprised if we just kind of meddle around here at these levels through the end of the year. Of course, anything can happen. We all know October is typically a very volatile month, especially in election years. So that'll be definitely worth watching. But we think we'll be higher. Those are the estimates. Then next year we think we'll be modestly higher than this year end. So again, we're reasonably optimistic. That's pretty much true of all the asset classes, but we do like, Wells Fargo does like the US more than international. We like big, stable blue chip companies, medium-sized companies, and we're a little less optimistic about the small companies, which have some problems accessing capital, but we like big stocks. 10-year treasury at 0.66. We think that'll tick up a little bit. We don't think inflation is going to be a problem. In fact, it looks like on Thursday, the Fed's going to make some announcement. They're going to adjust how they tackle inflation or even think about inflation going forward. So that'll be telling. There's no reason to think that inflation is going to be a problem in the near future. If you want to jump ahead a couple pages and get to page 10, get into some of the numbers for the pension. So end of quarter, June 30th, 36,285,648, which is certainly welcome when you contrast that with the 331 number of 32 million. So we're 4 million higher than we were at the most recent quarter check. So that's good. Gain loss since inception, you can see the numbers for yourself. Back to 2013, portfolios gained $14 million. And you see the net contributions and the flows. On the next page, you have the equity and fixed income, basically 60-40 allocation. That's been steady. On page 12, you see the 12 equity managers, the 4 fixed income managers, and how we allocate those. And on the next page, page 13, probably the most important page, talks about the returns. So in the quarter for the market, city, police, and fire, pension. Quarter's up 14.61%, ahead of our benchmark of 13.16. Year to date, down 0.56, ahead of our benchmark of negative 1.84. So we're really happy with the quarter. We beat all of our benchmarks in all the asset classes where we manage against benchmarks for the quarter. Feel good about the year to date numbers. So, you know, I don't think anybody would argue that the position we're in now is much stronger than anyone could have perceived on March 23rd. So it makes your jobs easier, certainly as board members and as good stewards. It makes our job easier to get decent markets and see some rally back. So we feel good about that. We feel good about our performance. And on page 15, you see the different asset managers and where we're strong and where we're weak. On page 16, in particular, our fixed income managers have done really well. Our U.S. large cap managers, the Dodge and Cox, has been fantastic. T. Rowe Price is one we're watching. It's a little weaker than some of the others. Emerging Market Fund, Acadian on page 16 is a little weaker, but you know, generally speaking, we're happy with what's happening in the portfolio. Going back to the returns again, you know, I would certainly wager that we're positive as of this moment. I haven't looked at the numbers, but positive year to date based on the market activity. So again, considering we couldn't hold our last meeting due to coronavirus issues, here we are sitting here with, you know, decent numbers. So that's okay. That's good. And we feel good about the portfolio. Any questions? Anything on your minds?
I have a question about something you said earlier. Did you, to clarify, I guess more or less, did you say that we are now above our year-end target, our pension fund?
The only thing I was referring there, and I'm just guessing, I have not seen the performance as of today. I was just making the point that I'm sure today you're positive year to date in the portfolio is my guess, but I have not seen that number. Just looking at the market activity from 6:30, you know, through now is the only point I was making.
Understood. Okay, any other questions for Jeff?
I don't have any offhand, no. Thank you.
Questions for Kurt? I don't have any. Mary or Gigi?
I'm good. Thanks, guys. Looking good.
All right. Yeah, thank you.
All right,
Great.
thank you.
Thanks a
All
lot.
right. I want to say thank you to Wells Fargo investors for making our meeting. We appreciate the presentation very much. Thank you.
Of course, thank you.
Have a great day.
Yep,
You
you
too.
as well.
Can we move on to item B, Mary? Michael Gano on the line.
Yeah, I'm here. Good morning.
Morning, Mike.
Sorry, I had a little trouble getting on. I clicked the Google link first and wasn't getting anywhere. So eventually I figured out I had to hit the Zoom link down below.
Confusing for me too.
So
What can you tell us?
well, hopefully I have some good news. So here to present the City of Marquette Police and Firemen Retirement System, December 31, 2019 actuarial evaluation. So as I'm going through, if you have any questions, feel free to stop me and I'll go over that. So the financial objective of the retirement system is to establish and receive contributions, hopefully as a level percent of pay that's sufficient to pay all your future retiree benefits. And so the reason we do the valuation is we develop that contribution rate, and the way we do it is we make a lot of assumptions about what's going to happen in the future. And we know that it's unlikely that we're going to meet all those assumptions. So by doing the evaluation every year, we can take into account any of those variations and reflect that in the contribution rate gradually over time, rather than if you did it over a longer period, you would have bigger gains or losses that you had to recognize in a report. The way we go about doing the valuation is we receive the participant data from Mary, which includes your current active members, all their payroll and their date of birth and hire information. Your deferred members that have left active service and are going to receive a benefit in the future. and then your current retirees and beneficiaries, all the retirees and beneficiaries that are receiving a benefit currently, and so updated information on them. We also get the assets on a market value basis, which we use to develop the funding value of assets in this report. I'll talk about that in a little bit. And then we have the assumptions that have been recommended by us and adopted by the board that we use. That includes things on the economic side, such as your rate of investment return of 6.75%, and your wage inflation of 3.5%. And then on the demographic side, that includes things like rates of disability, rates of withdrawal, rates of retirement. When do we think people are going to leave service, and how long do we think they're going to get a benefit by using the rates of mortality? And so we combine all those things together with our actuarial cost method, which is called entry age normal cost. And the idea of that is to basically allocate the cost for your active members' future retiree benefits over their working careers. And so we call it, that's the normal cost percent. And that's what you contribute each year on active member payroll and to try and fund those future retirement benefits. So we turn to page C3, if you have the physical copy of the report. If you have the PDF, it's page 40. This is where we show the financing diagram. And I talk about this graph every year, and it's basically if you start funding a retirement system and you're pre-funding it, at the start you have no retirees, you have no benefits going out. But if you look at that level blue line in the middle there, the dashed line going from left to right, that shows a level contribution percent, and that's ideally what we're doing with the normal cost percent. And so if you pre-fund, you pay that normal cost percent, you build up a pool of assets in the beginning when you're not paying out benefits. And then when you become a mature plan, like the city of Marquette is, and you go to the right side there, you'll see that the green line is cash benefits. So it started at 0. As you get retirees, it'll go up to the right there. And so out towards the right, you have your level contributions line is lower than your cash benefits being paid out. And the difference is made up by investment income. And so we assume every year that the plan is going to earn 6.75%. And, a portion of that investment income, or that some of that investment income, is going to offset the contributions to the city. And so the city's contributions as a normal cost percent are lower than the benefits going out. So over the past 10 years or so, the contribution rates have gone up pretty significantly, and that's due to the unfunded accrued liability and the amortization payment. But even with the contribution rates going up over the last 10 years, the employer plus employee contributions going into the system this year were about $2 million, and the benefits paid out were $2.4 million. So, even though it's closer than we would expect, given the life of the plan, the contributions coming in are still less than the benefit payments going out every year. If we turn to page B4, 26 in the PDF. This is where we show the development of the funding value of assets. And if you look at the top row there, 2019, we show the funding value at the beginning of the year. We have the market value at the end of the year. The market value at the end of the year was just under $38 million. And what we try and do here is, we look at market value as of a specific date. So the valuation is as of December 31, 2019. Now, we know that market value can be very volatile from day to day, month to month. And the idea with the funding value of assets is to take any difference in your assumed rate of return versus your actual rate of return and smooth it out over 5 years. So if you look at row E1, we had the market value return this year was about $6.2 million. E3, we expected about $2.3 million. And then E4 is the amount for the phase-in recognition. So we had a gain of $4 million that we're going to recognize 20% this year, and then 20% in the following 4 years. So on F1, you can see the $786,000, and that goes down to the right out to 2023. Now, then we have to, in addition to that, we have to recognize the phase-in amounts from the prior years. So we have a negative 809,000 from last year, positive 445 from the year before that, and then negative 15 and then a negative 443. And so our total recognized investment gain this year is negative $36,000. So even though we had a significantly good year this year with a market value rate of return of about 19.6%, we still show a recognized investment loss based on those prior bases. So, you know, that implies the system's working. We would tend to see some gains and losses there, and hopefully they offset. So that's actually not bad. Now, if you look at 2018, 2018 was the prime example of why we do the funding value of assets. So if you remember back in December 2018, the market basically plummeted from, you know, the last quarter of that year. And then by January to March, it basically rebounded and it jumped way back up. So for December 2018, we showed a market value rate of return that was actually negative. However, then that gets reflected in the December 31, 2019 return being so good. So, you know, because that month, the month before we recognized the valuation date was bad, they showed up negative in December 2018. However, we recognized only 20% of that loss in 2018. And now in 2019, when we get that bounce back, we're recognizing 20%. And if you look at row F1 and F2, our positive gain this year is about 786,000. Our negative loss from 2018 was 809. So those two bases going forward are basically offsetting. So that's good news in that respect. Now, the other good news on this chart is if you look at G5, we come up with the valuation assets of $36.2 million. That is $1.6 million less than your market value as of December 31, 2019. So what that means is we're going to recognize $1.6 million investment gains over the next 4 years. And you can actually see that if you look out in the phase-in amounts in 2020, we have a positive 406,000 on F6, positive 422 for 2021, small negative in 2022, and then a positive 786 in 2023. So that's going to put downward pressure on the contribution rates and upward pressure on the funded ratio. But also keep in mind that, you know, we're going to put in new phase-in amounts in each of those years, which will be 20% of the gain or loss in each of those years, and it could offset that a little bit. But the trend right now we see is that it's going to put some downward pressure on contribution rates. If you turn to page A2, page 7 in the PDF, here we show the contributions computed for the fiscal year beginning October 1, 2020. And we have two main components of the contribution rate. The first is the normal cost percent, and that's the ongoing cost of your active members accruing additional benefits. So each year an active member works, you're going to pay the normal cost, and then you're going to do that each year until they ultimately retire, and then that should be enough to fund their future retirement benefits. So we break it down by pieces here. We have the age and service benefits, 22.4% for police, 22.44 for fire. And then that's the bulk of the cost is members making it to retirement age and retiring with a full benefit. Then we have death and disability benefits. We have termination benefits. Deferred benefits are if a member is quits and is eligible for a benefit in the future. That's the deferred benefit. And then refunds of member contributions. If a member quits and is not eligible for a deferred benefit, they can take a refund of their contributions, and the minimum they can get back out of the system is the money they put in. And then we have administrative expenses, and that's 0.4%. And that just reflects the cost of the plan, operating the plan. And so it's a line item. It's basically the city pre-funding those administrative expenses. For a number of years, what we did is we just let the administrative expenses flow through the assets, and then they would work their way into the contribution rate in subsequent years. This is just basically doing it ahead of time for each of those years. Now that could change over time as we see what the administrative expenses are. We're kind of looking at like a 3 or 5 year average to come up with that. But that's the idea. So total normal cost for police is 27.2% and fire is 26.54%. And what we would normally expect to see is if there are no assumption changes or no benefit changes, we would normally expect to see that normal cost to stay relatively flat, basically very similar to last year. As you change population demographics, like if you hire younger people or older people than you used to in the past, that normal cost will gradually change. However, that should be pretty gradual. Last year, the police was 27.23 and fire was 26.53, so almost dead on. The next portion of the contribution rate is the amortization payment. So what we do is we have to look at your current liabilities based on your retirees and the present value of their future benefits, the deferred members and the present value of their benefits they're going to receive at some point in the future. And then we have your active members and the accrued liability they've earned to date. So, if you consider an active member that's hired today, they have no accrued liability. They haven't earned any of their benefit. However, if they have 20 years of service, you would have expected the city to make that normal cost contribution every year for over the 20 years. And we would expect to have a pool of assets built up for that to pay that individual active member's benefits. And so that 20 years worth of benefit accrual and, basically paying their normal costs, we come up with the accrued liability that reflects that. So they've earned a large portion of their benefit and they have a bunch of accrued liability. We add all the retirees, deferreds, and the active members together. We get your total accrued liability. We then compare that against your funding value of assets. And any difference becomes an additional payment or credit to the city. So since currently the assets are less than the accrued liability, the plan is underfunded and there's an additional amortization payment that has to be made. Currently, it's being amortized over a closed 18-year period for police and fire. And so we come up with 25.34% for police and 20.48% for fire. Now, the fact that it's a closed amortization period means it functions sort of like a mortgage, where we're going to let that amortization period continue to drop. And if you had no gains or losses, we would expect this amortization payment to stay basically the same for 18 years, and then it would be paid off. So we have gains and losses that will affect that over time. But that'll get rolled into the new period. Now, using a closed amortization period is going to pay off the unfunded accrued liability quicker than the alternative, which would be an open amortization period, which we used for quite a few years. And an open amortization period, what that does is it says, well, if you use a 20-year amortization period this year, you're going to use a 20-year amortization period next year. And so your amortization payment would decline over time very gradually. But at the end of 20 years, you wouldn't have paid off all your unfunded accrued liability. So it's a much more gradual process. Now, the reason I mention that is because the closed period has a disadvantage. It basically, when we roll in those gains or losses, if we're rolling in the gains or losses with a 30-year amortization period, they're going to have a pretty small effect overall. However, if the amortization period was get down to 5, let's say, now you roll in those gains or losses. They're amortized over a much shorter period. So gains or losses can have a much bigger effect on the contribution rate. So ultimately what we expect is just to let the closed amortization period decline down to 1 and let it go completely away. but at some point, either at a 15-year or maybe 10-year, we'll probably recommend doing a new amortization base where we would say, we're going to start a new closed amortization base at 20 years, and all your gains and losses would go into that one, and then that one would eventually run out. And so eventually we'll have a couple bases that are closed going to zero, but the idea is to not let those gains and losses be amortized over a super short period. So we get the total contribution requirement of 52.5%, 54% for police and 47.02 for fire. We take off the member portion, and so we get the total city contribution rate of 46.84 for police and 41.36 for fire. If you look at the next page, we have the dollar contribution. Basically, we just roll forward payroll with wage inflation for a year and a half, and then multiply the percent of contribution payroll that for the contribution rate times that payroll, and then we get the estimated dollar amount. So you could either use the payroll, your actual payroll times that percent, or the estimated dollar amount we come up with. And so we came up with $1,742,000 this year, and that's down slightly from $1,778,000 last year. And that's mainly due to a decrease in the contribution rate for police. If we go to, and so the reason for the decrease in the contribution rate, we had small investment loss, which we talked about on the funded ratio page, which was pretty tiny. And then we had mortality gains, mostly for police. And then we had salary increases lower than expected and more terminations than expected, mostly for police as well. So overall, it was a gain to the system, but most of it was directed at police. And so that's why we saw the police rate go down and the fire rate basically stay the same, maybe just up a little bit. If we go to A5, just the next page there, actually 2 pages. We show the funded ratio on this page. And so the first column is your funding value of assets, the $36.2 million there. And then the third column is the accrued liability. So that's 48 million, just over $48 million. The difference between your accrued liability and your funding value of assets is just over $12 million. And so the funded ratio, the assets divided by the liability is 75%. That's second column from the right there. And that is up from last year, which was 73%. So normally what we would expect with the city making that additional amortization payment is we would expect that funded ratio to go up over time. Last year it went down because we had investment, the actuarial losses. This year it went up because of the payment and we had gains. So if you had no gains or losses, you would expect it to steadily increase to 100%. With gains and losses, it can kind of jump around a little bit, and gains will speed it up, losses will kind of drag it out a little bit. But that's positive news. A6, the next page. Here we just show a breakdown of how the assets get allocated. So we have the second column from the left there, the 2.4 million. That's the member contributions that have gone into the system. So, basically that money would have first call on the assets. Then we have the retirees of liability of 26.3 million. And then the remainder is your actives and your deferreds of 19.5 million. So if we divvied up the assets, going to the member contributions, then to the retirees, how much would we have left over for the actives? And we would basically have 100% for the member contributions, 100% for the retirees, and then we would have 38% to fund the active and deferred benefits. So that's nothing to be too concerned about, but it is something just to be aware of. Ultimately, we look at the overall funded ratio of 75%. We would like that to be at 100. Generally, 80 to 100 is expected to be good shape. And you know, we're making progress towards getting back to that. If we look at A7, next page. Here we show the historical contribution rates. And so you can see down the bottom two rows there, police was down from 48.19% to 46.84% this year. And fire went up from 41.26 to 41.36. Look at A10. We go through the comments here. I'll just talk about a couple of them. Comment B, for the year ended December 31, 2019, the 13th check reserve was $788,953. And basically, we know that money is in the system, but we know it's going to be paid out as a 13th check. So we hold it as a liability to basically offset that. So it doesn't get used to reduce your future contribution rates. Comment F. This is basically if you use, so we use the funding value of assets for the reasons I discussed. But if we were to use market value of assets, the police contribution rate, instead of being 46.84%, would have been 43.52%. And for fire, it would have been 41.36 down to 38.6%. So over the next 4 years, if we have no gains or losses, we will see the contribution rates trend down to those lower numbers. So that's at least our expectation at this point. Comment G, similar idea, but just with the funding value of assets versus the market value of assets for funded ratio. And that would go from 75% using funding value to 78% using market value. So that's also, so that's even without, over the next 4 years, we would expect it to go 78%, even without the additional city contributions. So right now we would be looking, you know, over the next 4 years, getting close to 80%, assuming no future gains or losses. And comment J just talks about the administrative expense load. And then in conclusion, it's the actuary's opinion that the contribution rates recommended are sufficient to meet the system's financial objective. Are there any questions?
I have a
I
question,
don't have
Mike.
any.
I got one quick question for you, Mike. Comment B. Do you observe that full $700,088,953 when making that determination? Because we only contribute half of that to the 13th check, typically.
Contribute half to what?
The investments. Am I looking at the wrong? I have the wrong idea about that $700,000. That's not investment. Because
Well,
our investments are put towards a 13th check. Half of it.
the 788 is the accumulated account balance for the 13th check reserve. So
Over the course of 20 some years.
yes.
Okay.
And so as you get additional investment gains, I don't remember offhand how new money gets allocated to that account, but that's my understanding is that's the accumulated amount that's already there. And so, you know, as that account increases, so if $200,000 was to go into that account and didn't go to investment income to the retirement system, then, you know, that's money that isn't offsetting the future contribution rates. And so that's why we include it as a liability. We basically say there's $800,000 there, but we know that it's only going to be used for the 13th check. And so we just basically put in a liability that matches that and says, okay, we're going to basically zero out those assets when we determine the contribution rate. we don't really take into account the idea that future investment income is going to go in there. When a future investment income does go in there, it basically becomes a small loss to the system in the year that happens.
Okay, thank you.
Yep.
Any other questions?
I don't have
I'm
any
good.
offhand. Thank you.
Sounds like Mary's good. Ken, did you have one?
Nope, I didn't. Thank you.
Okay. And Gigi, any questions?
Gigi is muted. Gigi, I don't know if you know how to unmute yourself, but on your screen, if you look in the lower left-hand corner, you should see a little microphone or a phone with a red slash through it. If you have any questions, go ahead and unmute yourself too.
I'm not hearing any questions from Gigi, so I think it's fair to move on. Mike, thank you for the presentation. We appreciate it. Appreciate you being on the Zoom with us today.
You're welcome. I have just one more comment. I didn't mention anything going on with coronavirus. I heard the tail end of the investment spiel there. Things seem to have rebounded pretty well. So, you know, it's so far, at least at the moment for the retirement system, it doesn't look like it's going to be a major hit like 2008 and 2009. You know, back in March and April, we started to think that maybe it was going to be, you know, a really bad year in terms of that. But as of now, you know, it seems to have rebounded. So we'll see how it goes. But also keep in mind that, you know, if it does turn south again, you know, we're going to recognize 20% of any loss this year. So, and we also have those built up investment gains. So that, you know, we have a cushion in terms of the investment performance on that side. So just something to keep in mind there. But thank you everyone for your time.
Thank you, Michael.
Thank you.
Thank you, Mike. Okay, that was item B for presentations, and we don't have any more presentations. Move on to item 4, the consent agenda. Ken, are you prepared to read from the February 25th minutes?
I am. Just give me a second here.
No problem.
All right, February 25th, 2020. Meeting was held in the city manager's conference room, Marquette City Hall. Called to order. Members present, Gordon, Lamar, and Mary Schlitt. And Mike Harchkowski. We had a presentation here with Wells Fargo. Quarterly report. Current market value of the pension fund was $34,686,931. That was as of 12/31/2019. Ending value was $37,758,956. Market growth is expected to slow. However, the same was said at the start of 2019. We found out a month later that it definitely slowed down. Consent agenda after that, approve the January 28th meeting minutes. Motion by Gordon, second by Lamar, motion carried. 4-0. New business financial reports, reviewed, received, and filed. Quarterly pension enhancement account, December 2019, reviewed, received, and filed. 13th check discussion. February 2020 estimates a total of $65,980 to be distributed. Motion by Gordon to approve the 13th check, second by Lamar, motion carried. Item D, new business service continuity with Principal Trust Company, received, reviewed, and filed. Members were given a copy for review. Item E, city administration policy concerning chiefs or administration receiving annuity payment, police and fire. We were given a copy to review and since has been tabled. Open comment was Member Gordon was actively seeking prospective board members for openings. Adjournment, motion by Gordon, second by Lamar. Carried. Next meeting date was March 24th, which we know was canceled. That's all for the meeting minutes from February.
Okay.
I've got a text from Gigi that she has made a motion to accept the minutes as written.
Can I second that, or do we have to have another member second?
I can second as chair. I can take care of that for you.
All right,
Aye.
thank you. All in favor? Aye.
Aye.
Any opposed? Passes. Moving on to item 5, old business, the city administrative policy.
Well, I
Any
hope you guys
discussion on that?
Yeah, I hope you guys have had plenty of time to review the administrative policy. Again, this was just that, in essence, annuity withdrawal options and all other retirement options, they're very specific in the union contracts, but those options are not clarified in the non-union contracts, so captains and chiefs and things like that. So this policy was written just in a way to make sure that there were clear, definitive ways to make sure that those are handled the same way as union retirement options were.
So we're just extending what our union members get from the pension, and we're extending that to the non-union members, the chiefs and captains. Correct?
It's a clarification. I believe they were always covered under these, just under PA 345. But this is just making it totally clear that yes, the non-union members will be treated the same as the union contracts.
They will be allowed to withdraw their annuity payment upon retirement, is what I gathered from that, which is what they always were able to.
Yes.
Okay.
Yep.
Just that one paragraph, I think, that was changed or added. I didn't,
go ahead.
on my review, I didn't see anything that was necessarily, it all looked good to me.
I didn't see anything.
So, do you
Should we
need a
do
motion?
a motion to accept this, or should we do a receive, reviewed, and filed?
No, I do need a motion, if I can get a motion to approve the policy.
I can make a motion that we approve the changes to the administrative policy concerning the chiefs
I will second.
and captains, I guess, on police.
Mary second. We'll do a vote. All in favor? Aye.
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 Any opposed? Not hearing any opposition. We'll move on to item 6 then, our new business.
Gigi
Item
is
A.
texting me. She has also given an eye to that policy, so
All right.
we're working through this.
I think she can press like #7 and it unmutes her phone. I'm not quite sure though. I can't figure it. I'm trying to figure it out right now, but
Okay.
I don't use the phone controls very often.
Okay.
Thank you, Sean.
We'll move on to item 6A, the financial reports as of July 30, 2020. Mary, do you have those?
I do. So this is going to be item 6A in your packet. Everything's labeled in the upper corners. These next few items are just going to be kind of received, reviewed, filed type situations. But as of July 31, 2020, the total portfolio balance was $37,499,000. Breakdown of that, we had about $100,000 in checking, and the remainder was in the investment account. Activity for the month, we had an increase of $24,794 in the checking account. That was primarily due to the employee contributions to the fund or to the system. And we had an additional $1.1 million in the investment account. Breakdown of that, we had about $5,000 in dividends and interest, $138,000 in capital gains. The retiree payouts is hovering right around $202,000 now every month. And we had our quarterly administrative expense of $26,000 also go out. Fair market adjustment, this is the assets that we're holding and not sold, was $1.19 million. So overall for the year, we're looking at about a $2.7 million increase in the investment account. Any questions?
None
for
from
me.
Ken. Nope, thank you.
Okay. We'll receive, review, and file that.
Perfect.
Thank you, Mary.
Yep.
Move on to item 6B, the pension enhancement account as of May 31st, 2020.
Yep. So this is that $788,000 that you were discussing with Michael Gano, and that was the balance as of December 2019. Since then, we have made that distribution for the 13th check distribution, which now brings our balance down to $722,000. Now that we have the investment report, I will be able to add the quarterly investment returns, which was 14.61%. That's going to add another $90,000 to this account. So that's going to bring, the principal balance is the 722, spendable is the 618. So I might have to rethink how we do this presentation. But again, that one is just received, reviewed, filed. We're just trucking along, keeping that one in place.
Okay. Item 6B is received, reviewed, and filed. Move on to item C, summary annual report as of September 30th, 2019.
Yeah, providing this to the board for their review. This is annually provided to all active and retirees. We used to send this out with the 13th check before that went as a direct deposit. But now these are sent out annually right about the same time. It's kind of that one-stop summary that gives a real quick review of the financial position, the investment portfolio, and the actuarial updates.
So we'll be sending this out, or we can just have it on file for members to review.
It will be, yep, it's on file. It's posted to the website, and it was sent out to retirees specifically, I think mid-May.
Okay. Okay. Thank you. Receive, review, and filed?
Yep.
Okay. Moving on. If we have no questions on that.
None from
Moving
Ken.
on. Okay. None from me. Item 6D, review of the fiduciary liability insurance.
Yeah, this I will need a motion on. We are looking to renew our fiduciary liability insurance premium for September 2020 to September 2021. I included a final page that kind of showed that we are experiencing a $33 increase over last year's premium. Last year was $4,452. This year we're looking at $4,485.
Okay, and there are some years where the increase has been $300 or $195. Now this is just $33. Granted, we've had years where there's zero increase, but this is still, seems like within
It's in
reason.
line. Yeah, it's in line.
Okay. I have no discussion or questions on this. Anybody else?
I do not. I'd move to make a motion to accept the, I don't know how you'd word that, I guess. Accept the new insurance package.
We can accept to pay that bill?
Yep, that'll work.
Okay. I'm hearing a motion. Anybody second?
I'll second.
Thank you, Mary. All in favor? Aye.
Aye.
You agree on that? Ayes?
Yep.
Okay. And then Gigi, if she texts in. I'm not hearing any nays at this point.
Oh,
We're
Gigi
gonna
has a
pass.
question. Yeah,
Oh.
Gigi has a question.
Okay.
Hey, Gigi, try pressing *6. That might work.
So Gigi is asking, who does the fiduciary insurance cover? This does, there she is. I can see she's unmuted now. So this does cover the board should we make any errors or breach of duty. So for example, let's say for instance, like last year we had that duty disability come up for question. And let's say we denied it, but it later went into litigation saying that we should have approved it. This is kind of what that umbrella policy covers. It covers the legal situations that we would get ourselves into for errors or breach of contract. Does that make sense?
Yep, makes sense to me. Gigi, looks like you're unmuted. Are you there? Not hearing anything. There it is. Gigi was on for a sec there. Not hearing any other questions or discussion. We were in the middle of a vote on this. I don't think that changes anybody's mind and information. Mary, move forward on the vote.
Sounds good?
Okay. Did not hear any nays. Still not any nays. Maybe Gigi will text in her vote in a little bit, but for now, 3-0. Motion to pay this bill passes. Move on to item 6D. Invoice services from Van Overbeek, John, Timmy, PC. This is who we normally do our legal research with.
Yep, I'll be seeking approval to pay this $351 invoice. Just to note, I mean, I know we've had questions in the past about paying for these services. Since March of this year, we have received 12 legislative summaries or updates. One of these updates actually required us updating all the correspondence that we give out to our retirees based on the changes that came about under the CARES program. So he's been very active in keeping us covered on anything that's gone on with a lot of legislation that's come through in the last 5-6 months. So I feel that this is kind of a pretty fair invoice that we can pay to Van Overbeek.
Okay. And for the sake of discussion, I'm looking at some of the hours they charged on some of the things that we've received from them. They're charging
Yep.
like 20
Yeah,
minutes,
remember
20 minutes, 20 minutes. I know that the research has probably taken a lot more than 20 minutes. So,
right. Well, what
again,
he does is he provides the update and then he spreads that cost out to all of the members. So we're only being charged for a portion of his time in doing these legislative updates. And then they do also bill out the other systems that are in contract with Van Overbeek.
So that'd be citywide
Okay.
then, that's not just us.
Mostly it's going to be a lot of our MAPERS members.
All right. Is that something that we solicit or they take upon themselves to update us?
It comes about with our MAPERS membership.
All right. Alrighty.
Mary, have you seen the benefit from them doing this?
Yes. Yeah. Because he can be so specialized under programs like PA 345, he does help a lot.
Okay.
I'd
I
like
have nothing
to,
more for discussion.
I'd like to make a motion that we pay.
Sorry, guys, I got a motion from Gigi to pay it.
That works too.
Okay.
GG, seconded by Ken.
Yep.
Sounds good.
Okay, we're gonna make a vote on this to pay the invoice for legal services from Van Overbeek. All in favor?
Aye.
Aye.
Okay. Not hearing any nays. Motion will pass 3-0. Moving on to item 6F. This is the committee report to the City Commission, scheduled for August 31st at 6 p.m.
That is all going to be you, Archo. This is the presentation as it currently sits. I have updated slide number 5. At the time that I wrote this up, we didn't know the since inception percentage of growth in the investment account. That is 6.63% since inception. So just wanted to allow you guys to look this over. Let me know of any changes, if I can get those changes by tomorrow at the latest. Because, yeah, Archo, you're going to be up to present this next week.
I would assume all that's going to be on the Zoom platform again there? Or,
Yeah.
No.
Yep.
Okay. Duly noted. I will do the presentation in front of City Council. How can we disposition this? Would you like a received, reviewed, and filed?
Just it's for information only, so
Okay.
no motions need
Any
to be made.
questions on that? Are there any questions on the City Commission report about to be done?
not from Ken, nope.
Okay.
Let me know if you need any help with that in any way, shape, or form.
All right, thank you.
Should be all right. I should
I
be
can
all
clean
right.
your office for you.
We'll move on to item 7. Is there any public comment?
There's none.
I'm not seeing or hearing any, so we'll move on to item 8, comment from members. Any members wish to speak?
Earlier, Gigi said that she has been in contact with Judge Greeley about joining the board. Still waiting for a response.
Anything else from members? Mary or Ken?
Not offhand, no. I think this Zoom platform worked pretty good for us, so didn't have to worry about parking at City Hall anyways.
Yeah, I will
Okay.
continue to just kind of review activity that's going to come through in the next month. I mean, we had a lot of actionable items this month just because we haven't had a meeting since February. So I think this one really succeeded in wrapping up a lot of those loose ends, and we're in a good position to finish out our fiscal year end.
Okay. Mary, do you think we're in a good position at this point to say whether or not we're going to have a September Zoom meeting, or can we put that off?
Yeah, at this point, I don't see that we would need to have one. If anything comes up, I'll let you guys know.
Okay, is there anything else? Not hear anything? I would like to thank all the members and the presenters for working through the Zoom meeting today. And I think it's important to show the members, those that are collecting in retirement, those that are putting into it, that we're still meeting, that we're still working through these actuarials and the quarterly reports, and getting votes done and managing the pension. So again, I thank the members and I thank the presenters today.
Thank you.
A motion for adjournment.
Me too.
Second.
Motion, well, we'll do a vote. All in favor to adjourn?
Aye.
Aye. Any opposed? Not hearing any. We'll adjourn at 11:16. Thank you.
Thank you, guys.